How to use pivot points in day trading. The job of the day trader is to make sense of daily price fluctuations when trading futures, stocks, commodities, options, or currencies. Technical indicators are useful tools in helping determine where market prices are likely to go next. And one of the more accurate and therefore useful indicators is the pivot point approach. As with all technical indicators, learning how to use pivot points in day trading requires both study and practice in simulation trading. What are pivot points and how are they calculated? The pivot point, or P, is a single price level calculated from the previous day's trading. It is used for determining likely support and resistance levels for the current trading session. The pivot point for a given day is the average of three prices: the previous day's high, low, and close. P equals the sum of the high, low, and close divided by 3. Trading above the pivot point is a good indicator of bullish sentiment, and trading below the pivot point usually indicates bearish sentiment. However, in order to get more help in determining likely support and resistance levels and levels for setting stop-loss targets, one uses a few more pivot points based on P. These are as follows: Resistance 1, R1 equals 2 times P minus the low. Resistance 2, R2 equals P plus the difference between the high and the low. Support 1, S1 equals 2 times P minus the high. Support 2, S2 equals P minus the difference between the high and the low. Using pivot points to identify key support and resistance levels. Because pivot points for a given day are based solely on the previous day's trading, they do not change during the day, unlike a moving average. Thus, a day trader can more easily plan their trading day based on the support and resistance levels predicted by the pivot point system. While prices trading above or below the pivot point, P, indicate whether the market will be bullish or bearish, the resistance and support levels are useful in helping one set trade entry and exit points, as well as stop-loss levels. Pivot point trading strategies. Successful day traders do not just randomly place trades throughout the day. Rather, a disciplined trader will follow a set trading strategy based on what the market has been doing and what indicators tell them it is likely to do next. Essential to this task is having a clear idea of when prices will come up against support or resistance and when they are likely to break through. By using the pivot point system, a day trader can often more easily identify trade opportunities and specific points for trade entry and exit. Combining pivot points with technical indicators. There are no perfect technical indicators, and that includes pivot points. However, pivot points are good indicators and are even better when combined with other indicators, like moving averages, the moving average convergence and divergence indicator, MACD, or the relative strength index, RSI. For example, when the information you are getting from a pair of moving averages confirms what you are getting from pivot points, this can be an extremely accurate trading indicator. Common mistakes to avoid. When using pivot points, not only are there no perfect technical indicators, but there are also no magic wands in the day trading world. The point is that a day trader should never blindly follow any technical indicator, including pivot points. Although the day trader is always watching moment-by-moment price action, it is essential to always have a sense of what is going on in the broader market and outside world. Using at least one other technical indicator, as well as paying attention to news feeds, market fundamentals, and economic calendars, are all good ways to avoid pitfalls when using pivot points. Thanks for watching. Please subscribe to my channel. And don't forget to download the free training guides in the description box below this video.